One fund owns America's biggest companies. The other bets harder on companies shaping tomorrow. At first, VOO and QQQM look like simple choices. But underneath, they are two very different bets. VOO tracks the S&P 500, giving you broad exposure to large American companies across many industries. QQQM tracks the Nasdaq, focusing on 100 large non-financial companies listed on Nasdaq. That difference sounds small. It is not, because your fund decides which businesses receive most of your money.
VO charges just 0.3%. QQQM charges 0.5%, 5 times more, though both remain relatively low cost.
Is the first twist. The cheaper fund is not automatically the better investment. Cost matters, but what you own matters more. Imagine investing $10,000 today. You are not simply choosing between two tickers. You are choosing two different engines. VOO spreads your money across technology, finance, healthcare, energy, industrials, consumer businesses, and more. QQQM leans much harder toward technology and growth. That can create bigger upside, but it also creates bigger concentration risk.
Now look at their biggest companies. Many names driving QQQM also sit inside VOO.
So buying both does not automatically create the diversification many beginners expect. You may double down on the same giants. That is the hidden part of this battle. The question is not simply which fund wins.
The better question is this: what risk are you willing to accept for the chance of higher growth?
VOO follows broad American large caps. QQQM makes a stronger bet on Nasdaq's biggest non-financial companies. One gives you broader exposure. The other gives you more concentrated exposure to companies driving technology and growth. For a beginner, the right fund starts with your plan, not whichever ticker looks hottest on social media. A hot fund can look unbeatable after a great run, but past winners can still suffer long, painful drops. This matters because growth can come with bigger swings, and bigger swings can test your patience at the worst time. Imagine seeing your account fall 20%. Could you keep buying without panic, or would fear make you sell?
That is where many investors lose. They choose a fund for growth, then abandon it when growth gets painful.
If you check your portfolio every hour, normal market noise can feel like a crisis. That changes your decisions. For long-term investors, the biggest edge may be simple. Keep adding money, stay patient, and let time work. You do not need to predict every market move. A steady plan can matter more than perfect timing. Before choosing, ask 3 things: how long you can invest, how much risk you accept, and what growth means. If broad exposure helps you sleep better, VOO may fit your plan. Simpler can be powerful. If you want more growth focus and accept sharper swings, QQQM can make more sense for your risk profile.
So which one wins? There is no universal winner. The best choice depends on the investor holding it.
Build the choice around your plan. Keep your costs low, invest consistently, and know what you actually own.
VO or QQQM is not the real battle. Your real advantage is choosing wisely, then staying disciplined for years.
Now you know the real trade-off. If this helped you choose, like the video, subscribe, and share your pick below.